Thanks for coming out. Well, that's fine. No, we get over here. Yes. All right.
Oh, yeah, it's fine.
That's not good.
I come to a lot of speakers here, there's politics, just have such great speakers. World class. Very impressive.
Oh, well, we don't want to. I said it, we're all, the three of us were you literally all got that. Yes. Three amigos there. And then, so they're okay, like, yeah, that's right. And then they like international traveler, man of mystery, like something to say it's Harvard, Kennedy School, and you're about your big kind of messed up Harvard. It's just like they've been paying high fees Like originally, they everybody started copying what was yeah, I heard that.
$51 billion.
Still very.
Yeah.
So compare
Which is
problem is, yeah. They have those. Still does, the arts. But, I looked it up. My whole thing is, at the end of the day,
Dude, I had
Yes, actually, that's how it was.
Good evening. I'm Doug Hicks, president of Davidson, and I want to offer a warm welcome tonight. Thank you for coming out to hear one of the most important figures in managing and steering our economy, and a former Davidson colleague, Dr. Philip Jefferson. It's so good to see you, and welcome back to campus. At Davidson, when we talk about our mission, we emphasize how we cultivate, say it with me, we cultivate human instincts and creative, disciplined minds for lives of leadership and service. Students, we want you to gain the deep human and analytical skills that you need to navigate the world, and to do so during your time here and after graduation, to enter jobs that maybe didn't even exist when you enrolled here 4 years prior. During his time as our Vice President for Academic Affairs and Dean of the Faculty, Philip Jefferson not only ensured that we fulfilled our mission, he exemplified much of it. Philip once said that when he started college at Vassar, they didn't have a banking or a business degree, so he studied economics. That seems to have worked out pretty well. Like Vassar, Davidson is a liberal arts college, and our faculty and staff mentors guide students in building critical skills such as finding those connections between seemingly unrelated problems, asking questions in a way that lead to productive answers rather than reinforcing a presumption, and learning to pivot to another approach when the first one doesn't work. The Federal Reserve's mission is focused on capital. At Davidson, we are creating human capital. We're cultivating deep capacities and transferable skills that enable our graduates to succeed amid ambiguity and constant change. That's why you see so many of our alums, including alums of our administration, in the top ranks of the most important institutions within our economy. Now, so let me say thanks to Dr. Jefferson, Professor Jefferson, for being with us tonight. It's an honor to be a part of this event. And I'd like to introduce one of our outstanding students to make introductions. So please meet Tara Baumler of the class of 2026, a math and economics major from Superior, Colorado. And she'll introduce our speaker. Tara?
Good evening. Thank you, President Hicks. I'm here tonight to introduce Dr. Philip Jefferson. Although he now works at the Fed and his office is now in Washington, he remains a Wildcat to us. It is such an honor to have Dr. Jefferson here with us tonight. For aspiring economists like myself, this is even better than if Taylor Swift had shown up on campus. I was going to say Steph Curry, but I thought that might be pushing it. It might get me in trouble here at Davidson. During his long and distinguished career, Dr. Jefferson has served in roles including an economist at the Board of Governors of the Federal Reserve System, president of the National Economic Association, and professor and chair of the Department of Economics at Swarthmore College. And most recently, just prior to his role at the Fed, Dr. Jefferson served as vice president for academic affairs and dean of faculty, and he was the Paul B. Freeland Professor of Economics at our very own Davidson College. Dr. Jefferson quickly became an integral part of our strong community after his arrival in 2019. He is quick in any setting to give credit to his mentors and teachers who guided him at critical moments, precisely the culture that Davidson seeks to create. Dr. Jefferson received a BA in economics from Vassar College and an MA and PhD in economics from the University of Virginia. He served 20 years on the Vassar College Board of Trustees. He was even elected to and served on the local borough council in Swarthmore, Pennsylvania, a choice that remains confusing to some of his colleagues who feel that faculty politics is challenging enough. Dr. Jefferson was nominated by President Biden for the Federal Reserve Board of Governors and, in overwhelming bipartisan fashion, was confirmed by the U.S. Senate in a 91-7 vote in 2022. In 2023, he was nominated for the vice chair role and was once again confirmed in an overwhelming 88-10 vote. It is clear that Dr. Jefferson's career has been in service of helping others and in making our nation and our world a better place. Earlier this afternoon, a handful of my classmates and I had the incredible opportunity to meet and participate in a discussion with Dr. Jefferson. His words were both informative and inspiring, and he was so generous in sharing his insights, experiences, and advice. Thank you, Dr. Jefferson. It was an experience that we won't soon forget. We all look forward to your talk this evening. So please join me in welcoming the Vice Chair of the Federal Reserve Board of Governors, Dr. Philip Jefferson.
President Hicks and Tara, thank you so much for the kind introduction. Let me start by saying that I am saddened by the tragic loss of life that has happened here in North Carolina due to Hurricane Helene. And I know it's been a tragic experience for everyone who may be connected with that tragedy in some way. My thoughts are with the people and communities affected, including those in the Davidson College family. For our part, the Federal Reserve and other federal and state financial regulatory agencies are working with banks and credit unions in the affected area to help make sure that they can continue to meet the needs of financial services and of the communities that are affected. I'm happy to be back here at Davidson College. This is a special community. I'm bound to it by a shared experience defined not by its length, but by its intensity. As I visited with you today, and as I look around this hall, I see the faces of colleagues who became dear friends during the COVID-19 pandemic. Back then, we spoke often about how much unprecedented uncertainty we face. Amidst that uncertainty, however, we supported each other on this campus. Now, looking back, I can attest, or we can attest, that the mutual support was vital. I am grateful to have been amongst you during that unprecedented time. Today, I am proud to see that Davidson is as strong as ever. I'm excited to be here with you this evening to talk to you about the history of the Federal Reserve's discount window. The discount window is one of the tools the Fed uses to support the liquidity and stability of the banking system and to implement monetary policy effectively. It was created in 1913 when the Fed was established. Today, more than 110 years later, this tool continues to play an important role. At the Fed, we always look for ways to improve our tools, including our discount window operations. Recently, the Fed published a request for information document to receive feedback from the public regarding operational aspects of the discount window and intraday credit. So today, I will do three things. First, I will discuss briefly my outlook for the U.S. economy. Second, I will offer my historical perspective on the discount window, starting in 1913 and ending in 2000. Finally, I will provide a few details about the request for information that the Fed recently published. Tomorrow, I will say more about the discount window when I speak at the Charlotte Economics Club. Economic activity continues to grow at a solid pace. Inflation has eased substantially. The labor market has cooled from its formerly overheated state. As you can see in slide 3, personal consumption expenditures prices rose 2.2% over the 12 months ending in August, well down from the 6.5% 2 years earlier. Excluding the volatile food and energy categories, core PCE prices rose 2.7% compared with 5.2% 2 years earlier. Our restrictive monetary policy stance played a role in restraining demand and in keeping longer-term inflation expectations well anchored. As reflected in a broad range of inflation surveys of households, businesses, and forecasters, as well as measures from financial markets. Inflation is now much closer to the Federal Open Market Committee's 2% objective. I expect that we will continue to make progress towards that goal. While overall, the economy continues to grow at a solid pace, the labor market has modestly cooled. Employers added an average of 186,000 jobs per month during July through September, a slower pace than seen earlier this year. As shown in slide 4, the unemployment rate now stands at 4.1%, up from 3.8% in September 2023. Meanwhile, job openings declined by about 4 million since their peak in March 2022. The good news is that the rise in the unemployment rate has been limited and gradual, and the level of the unemployment rate remains historically low. Even so, the cooling in the labor market is noticeable. Congress mandated the Fed to pursue maximum employment and price stability. The balance of risk to our two mandates has changed as risk to inflation have diminished and risk to employment have risen. These risks have been brought roughly into balance. The Federal Open Market Committee has gained greater confidence that inflation is moving sustainably towards our 2% goal. To maintain the strength of the labor market, my FOMC colleagues and I recalibrated our policy stance last month, lowering our policy interest rate by 0.5 percentage point, as shown in slide 5. Looking ahead, I will carefully watch incoming data, the evolving outlook, and the balance of risk when considering additional adjustments to the federal funds target range, our primary goal for adjusting the stance of monetary policy. My approach to monetary policy making is to make decisions meeting by meeting. As the economy evolves, I will continue to update my thinking about policy to best promote maximum employment and price stability. Now I will turn to my perspective on the history of the discount window. Understanding this history is important as we consider ways to ensure the discount window continues to serve effectively in its critical role of providing liquidity to the banking system and the economy and financial system as they evolve. Before the Federal Reserve was founded, the U.S. experienced frequent financial panics. One example is illustrated in slide 6 with a newspaper clipping from the Rocky Mountain Times printed on July 19, 1893. It depicts panic swirling against banks at a time when bank runs swept through Midwestern and Western cities such as Chicago, Denver, and Los Angeles. The illustration shows how waves of panic hit public confidence, the rocks in the picture, and how banks have a fortress mentality. They stand strong against the pandemic, but they are not lending, and they are isolated. Back then, the supply of money to the economy was inelastic in the short run, in part because the monetary system of the United States was based on the gold standard. Demand for cash, however, varied over the course of the year and was particularly strong during harvest season when crops were brought to the market. The surge in demand for cash, combined with the inelastic supply of money in the short term, caused financial conditions to tighten seasonally. The banking system was fairly good at moving money to where it had to go, but it had little scope to expand the total amount of money available in response to the US economy's needs. So if a shock hit the economy when financial conditions were already tight, then the banking system struggled to provide the extra liquidity needed. Banks would seek to preserve liquidity by reducing their investments and denying loan requests, for example. Depositors, fearful that they might not be able to access their funds when they needed them, would rush to withdraw their money. Of course, that caused banks to conserve further on liquidity. In some cases, they simply closed their doors until the storm passed. When banks closed their doors, economic activity would contract. Activity would recover when banks reopened, but the economic suffering in the meantime was meaningful. In addition to the supply of money in the economy being inelastic in the short term, two prominent frictions, asymmetric information and externalities, made banks and private markets vulnerable to systemic crises. Here, asymmetric information refers to the fact that consumers do not have access to all the information they need to evaluate whether or not a bank is insolvent, illiquid, or both. Therefore, customers rely on imperfect signals, such as news reports about another bank failing, to decide whether to withdraw their money from their own bank. Then there are externalities, in the sense that an individual bank may not consider how an innocent bystander may be negatively impacted by its actions. When a financial institution fails, that may lead depositors to withdraw money from other unrelated banks, which in turn could cause those banks to fail. Contagion can transform a single bank failure into a systemic crisis where many banks fail, credit evaporates, the stock market collapses, the economy enters a recession, and the unemployment rate increases dramatically. The severe financial panic of 1907 stands out as an example of market failure due to these two prominent frictions. The panic was triggered by a series of bad banking decisions that led to a frenzy of withdrawals caused by asymmetric information and public distrust in the liquidity of the banking system. Banks in many large cities, including financial centers such as New York and Chicago, simply stopped sending payments outside of their communities. The resulting disruption in the payment system and to the flow of liquidity through the banking system led to a severe, though short-lived, economic contraction. This experience led Congress to pass the Federal Reserve Act in 1913. This act created the Federal Reserve System, composed of the Federal Reserve Board in Washington, D.C., and 12 Federal Reserve banks across the country. In 1913, the main monetary policy tool at the Fed's disposal was the discount window. At that time, the Fed did not use open market operations, the buying and selling of government securities in the open market, to conduct monetary policy. Instead, the Fed adjusted the money supply by lending directly to banks that needed funds through the discount window. The Fed's ability to provide funds to banks as needed made the money supply of the United States more elastic and considerably reduced the seasonal volatility of interest rates. This ability also enabled the Fed to provide stability in times of stress, helping banks that experience rapid withdrawals to satisfy their customers' demands for liquidity and thereby potentially prevent banking panics. In fact, many researchers have argued that the existence of the Fed's discount window prevented a financial crisis in the early 1920s, when the banking sector came under pressure as the US economy transitioned to a peacetime economy following the end of World War II. There had been an agricultural boom during the war and a significant accumulation of debt within that sector. Farmers came under pressure as the prices of agricultural goods dropped from wartime highs. The banks sought to support their customers, and the Fed sought to support the banks. There were serious concerns about the condition of several banks in parts of the country. The Fed's discount window lending provided critical support that saved banks, but also resulted in habitual use of the discount window by some banks during the 1920s. As slide 7 shows, that as of August 1925, 593 member banks, 6% of the total, had been borrowing for a year or more from Federal Reserve banks. Moreover, there were real solvency problems, and several banks failed with discount window loans outstanding. These challenges resulted in the Fed strongly discouraging banks from continuously borrowing from the discount window and the adoption of a policy of encouraging a reluctance to borrow. By 1926, the Fed was explicit that borrowing at the discount window was meant to be short-term. As I emphasized in slide 8, the Federal Reserve's annual report for 1926 stated that while continuous borrowing by a member bank may be necessary, depending on local economic conditions, the funds of the Federal Reserve banks are primarily intended to be used in meeting the seasonal and temporary requirements of members, and continuous borrowing by a member bank as a general practice would not be consistent with the intent of the Federal Reserve Act. In the late 1920s also highlighted Fed's concern about the purpose of the borrowing. The Fed sought to distinguish between speculative security loans and loans for legitimate businesses. A staff reappraisal of the discount window mechanism stated that, and I'm quoting, "The controversy over direct pressure intensified in the later part of the 1920s as an increased flow of bank credit went into the stock market." In short, the Fed observed that some banks were becoming habitual borrowers from the discount window. It was concerned that an over-reliance on discount window borrowings would weaken banks and make them more prone to failure. In the late 1920s, the Fed switched to open market operations as its primary tool for conducting monetary policy. That allowed the Fed to determine the aggregate amount of liquidity in the system and to rely on private financial markets to distribute it efficiently. The discount window would thus serve as a safety valve if there was a shock that caused conditions to tighten unexpectedly, or if individual banks experienced idiosyncratic shocks or somehow lost access to interbank markets. The intention of this setup was for banks to use the discount window to borrow from the Fed only occasionally. Ordinarily and predominantly, financial institutions were supposed to rely on private markets for their funding. This setup was designed to limit moral hazard, the possibility that institutions take unnecessary risks when there is no market discipline. This is the key balancing act. The Fed needs to be a reliable backstop to prevent financial crises, but it also needs to minimize moral hazard that comes from always standing ready to provide support. During the Great Depression in the 1930s, the banking system experienced severe stress, including many bank runs. There are many reasons why the discount window was insufficient to address the problems of the banking system in the 1930s. I will highlight only two. First, many banks were insolvent rather than illiquid. Central bank lending is not a fundamental solution in those circumstances. When banks are insolvent, it is important to manage the closure in as orderly a manner as possible. The establishment of the Federal Deposit Insurance Corporation, or what you may know of as the FDIC, in 1933 gave bank regulators increased ability to do that. Relatedly, the challenges experienced in lending to troubled banks in the 1920s likely made the Fed more reluctant to lend in circumstances which insolvency concerns were material. Second, the types of collateral that the Fed was initially able to accept when lending to banks were quite limited. In response, in the early 1930s, Congress expanded the range of banking assets that could serve as collateral for discount window loans and added a variety of new Fed emergency lending authorities. These new lending authorities were used in the 1930s to help alleviate distress. Some were also used in the early 1940s as the Fed helped support the World War II mobilization effort. The period following the war was relatively calm. The role of the discount window shifted from addressing distress in the banking system to acting as a safety valve to manage tightness in money markets and support monetary policy operations. In March 1951, the US Treasury and the Fed reached an agreement to separate government debt management from the conduct of monetary policy. thereby laying the foundation for the modern Fed. In the 1950s, the Fed set the interest rate on discount window loans above market rates. Thus, it served as an effective ceiling on the federal funds rate. The Fed continued to discourage extensive use of the discount window, but the relatively high interest rate also made its sustained use less attractive. In the 1960s, the Fed placed greater emphasis on open market operations to set its monetary policy stance. Concurrently, the Fed shifted to a policy of setting the interest rate on discount window loans below market interest rates. Because the interest rate no longer deterred use of the discount window, the Fed turned increasingly to other measures, such as administrative pressures and moral suasion, to limit the frequency with which banks requested loans from the discount window. Indeed, between the late 1920s and the 1980s, the Fed adopted and amended numerous restrictions on discount window borrowing. Whenever discount window usage increased too much, the Fed tightened the restrictions to suppress borrowing. For example, in the 1950s, the Fed defined appropriate and inappropriate discount window borrowing. In particular, the board's regulations in 1955 stated that, and I'm quoting, under ordinary conditions, the continuous use of Federal Reserve credit by member banks over a considerable period of time is not regarded as appropriate, end quote, and provided more details on how reserve banks should evaluate the purpose of a credit request. By 1973, the board had made additional changes to its regulations on discount window use and defined 3 distinct discount window programs: adjusted credit, intended to help depository institutions meet short-term liquidity needs; seasonal credit, intended to help small depository institutions manage liquidity needs that arise from seasonal swings in loans and deposits; and extended credit, intended to help depository institutions that have somewhat longer-term liquidity needs resulting from exceptional circumstances. Over time, the board added provisions in its regulations requiring banks to exhaust other sources of funding before using discount window credit. In addition, in the early 1980s, the Fed levied a surcharge on frequent borrowings by large banks to augment the administrative restrictions. Despite these policies to discourage use of the discount window, slide 9 shows that discount window borrowing, adjusted for the size of the Federal Reserve balance sheet, was notable in the 1970s and the 1980s, suggesting that the discount window was an important marginal source of funds for banks during that period. That changed in the 1980s and early 1990s when there were notable solvency problems in the banking system. During this period, the discount window provided support to troubled institutions, while the FDIC sought to find merger partners or otherwise manage the failure of these institutions in an orderly manner. The discount window activity that took place while the FDIC resolutions proceeded increased the association between use of the discount window and being a troubled institution. As a result, banks became more reluctant to borrow from the discount window. The greater reluctance to borrow from the discount window made it less effective, both as a monetary policy tool and as a crisis fighting tool. That resulted in a series of efforts by the Fed in the early 2000s to change how the discount window operates. Tomorrow, I will discuss those efforts when I speak at the Charlotte Economics Club. Before closing, I would like to return to where I began. Understanding the history of the discount window is important as we consider ways to ensure that it continues to serve effectively in its critical role in providing liquidity to the banking system as the economy and the financial system evolve. One way to ensure that it continues to serve effectively is to collect feedback from the public. Slide 10 provides some touch points for the board's request for information document. The request for information seeks feedback from the public on a range of operational practices for the discount window and intraday credit, including the collection of legal documents, the process for pledging and withdrawing collateral, the process for requesting, receiving, and repaying discount window advances, the extension of intraday credit, and Reserve Bank communication practices. My colleagues and I are looking forward to this feedback to inform potential future enhancements to discount window operations. The period for responding to our request for information ends on December 9th, 2024. Thank you, and to the event organizers and to the Davidson College community for the opportunity to discuss this important topic with you. It has been a pleasure to be back on campus. Thank you.
We have some Davidson College students who have prepared some questions for Vice Chair Jefferson this evening. So if I could invite whoever wants to start on that group, come on up, have a microphone on either end.
Hi, Dr. Jefferson. Thank you for coming to speak to us. So my question, especially in light of the jumbo cut last September of 50 basis points, does the Federal Reserve of today consider itself an institution more proactive or reactive to data that flows in from economic data sources and financial markets sources?
Well, thank you for your question. And I would say that, so the question had to do whether or not the Fed was proactive or reactive to information. I would say we have not changed our approach to how we do monetary policy, in that we are always in a situation where we have access to a vast amount of economic data. It's also the case that we have forecasts that are put together by our staff. And we're always thinking about the balance of risks to the different sides of our mandate. Remember, I said during my talk that our mandate from Congress is maximum employment and price stability. So as we conduct our policy, we're thinking about those three considerations. And our goal over the past 2 years has been to bring inflation down without causing an undue or unorderly increase in the unemployment rate. And that's why we held the policy rate at a very high level for an extended period of time, because we wanted to bring inflation down, and the labor market was performing very well. So the performance of the labor market gave us the headroom, if you will, to keep policy restrictive territory for a long period of time. Because we've had success in bringing down inflation, and the unemployment rate, as I mentioned in my talk, has slowly drifted upward, but still historically low, it seemed appropriate to recalibrate policy to pay increased attention to the other side of the mandate. Okay, so the size of the cut that happened in September was, I think, timely. So I don't think it was reactive. It wasn't necessarily proactive. It was timely and consistent with the capacity that we had allowed ourselves to pay attention to the other side of the mandate, given the success that we've made on inflation. So that's how I would respond to that question.
Another student's got a question?
So economic indicators across various sectors have shown substantial fluctuations. In recent months, we've seen significant revisions in unemployment figures, GDP estimates, and the personal savings rate. What are your thoughts on these changes? And with regard to these data revisions, do you believe there are emerging challenges in the process of collecting and analyzing economic data? Thank you.
Thank you for your question. It's a very good one and very important one because those of you who follow economic data certainly are aware that revisions are a part of what happens when statistical agencies release data. Sometimes it's the case that the data can get revised because over some period of time they get more information on the previous survey, more respondents come in, and so the initial report, say a month or a quarter later, can be revised. And this does represent a challenge for policymakers because policy has to be made in real time. What I first want to do is acknowledge the great job that the statistical agencies in the United States do. We are fortunate to have dedicated professionals who do that work. And I have great confidence in our statistical agencies. But to address the issue of revisions, as asked in the question, what that argues for is looking at a large amount of data from different sources in order to get a reading of what's happening in the economy. So it's important not to focus on any narrow measure of, say, what's happening in the labor market or what's happening with inflation, but rather to really try to get as much information from different sources as possible to see what story emerges from a more comprehensive look at the data. I like to think about it in terms of looking at the totality of the data. And we have a tremendous staff in the Federal Reserve Board and the system and system-wide. They have experience with these data revisions and they studied them over time. And so in that way, policymakers such as myself can not only receive the data from the statistical agencies, but we also receive analysis that help us to interpret these data. So that's a tremendous challenge that we face, but I believe that it's possible to take the data as a fact of life and the revisions process as a fact of life and still understand what's going on in the economy.
Another student question? Okay.
We have some back here.
Oh, sorry, just one more, excellent.
Thank you, Vice Chair Jefferson, for coming here today. My question is, there are lots of headlines about homeownership being out of reach for our generation. It's different from our parents or our grandparents. And do you agree with the risk posed in the headlines? And if so, how does the Fed view the short and long-term implication for economy?
Well, first, let me respond by saying that, you know, high housing costs are a strain for many individuals and families. And certainly that's something that I don't take lightly because, you know, for people to have access to housing is very important. Now, I also want to say that the Fed has been given a very specific mandate by the Congress, and that is maximum employment and price stability. And we don't have any direct influence over the supply of housing, for example. That is something that, from a public policy perspective, is outside of our purview, okay? So we have no direct way of influencing that, and for us to even try to do so, I think would be inappropriate. But it is the case that the housing sector is especially interest sensitive, and it is one of the sectors through which monetary policy is transmitted. The changes that we make to interest rates will end up impacting, say, mortgage rates and things of that sort. Now, what is essential for us to do at the Fed is to try to create an economy in which inflation is at our target, which is at 2%, and unemployment and employment is as high as possible. And if we are successful at doing that, then it will be possible for interest rates to be normalized. That's an economy that is experiencing long-run growth, one that has a low inflation rate and a robust labor market, okay? And if we do our jobs at the Fed, then we'll have that kind of economy where households and businesses can make decisions about whether to increase the housing stock or not, okay? So while we can appreciate the hardships that come with the difficulty of supplying, of affording houses, it is not something that we can directly influence. Now, let me say something about recent economic history, now that this is triggered in my mind. So before the pandemic began, the US was running low on housing stock. Okay, we went into the pandemic with a shortage of housing because, as a result of the great financial crisis, I'm dating myself here, in the decade after the great financial crisis, home building was very, very sluggish. And so when the pandemic hit and demand for single-family homes surged, we had an imbalance between supply and demand. The demand for homes was greater than the existing supply. And that's a part of why we saw an increase in housing prices and housing services prices, okay? Now, having observed that, at the end of the day, it's still the Fed's responsibility to bring the overall inflation rate down. And housing services is a big part of that. So a part of our policy challenge was to bring the demand for housing into better balance with the supply of housing. And then that is what would cause the housing prices to stabilize over time. Okay, so that's one of the features of our policy that has helped to bring the inflation rate down. And that process takes time. So this decrease in the rate of increase of housing prices has been gradual, but we've been making good progress on it. So let me stop with that there. That was a long answer to a short question, but I hope I didn't lose everybody in the process.
Thank you. Any more of our students?
If not, I'll take a question from an adult.
Okay, all right.
The students are adults also. Let me be, geez, I just.
Have one other one? Yes, sir.
So Governor Jefferson, do you think balance sheet policy as a tool only be used if we encounter the zero lower bound again? Do you think that there's an opportunity to use it to alleviate frictions that will arise in the mortgage market or the corporate bond market, even if the nominal interest rate isn't at the zero lower bound?
Now that is a very interesting question, which I don't know if everyone in this audience would even be familiar with. So I'm going to try to address it at a high level and say that right now we are not in a situation where the zero lower bound has to do with the possibility that interest rates will be close to zero, as they were, say, coming into before the pandemic. That is not the world that we are in now. And, we've gained some experience of what can be done in that situation in terms of the balance sheet. But I used the word earlier on with respect to normalization of interest rates. And a part of our balance sheet policy now is also moving in the direction of normalization. That's something that can continue to happen in the background as we recalibrate our policy. And my expectation is that that will continue to happen smoothly as it has, for the better part of a year or so. So that's all I want to say about that tonight.
One last question? Yes, sir.
You mentioned that 2% is the target inflation rate. Why 2% is the target rate rather than 2.5 or 3 or 1.5? Why 2?
Right. Well, that's another long-standing question. I think so. Let me just say at the outset of this question that 2% is our target now, and I expect that it will continue to be our target. There are multiple ways to answer that question. Let me try to take the simplest. And what happens is over time is that technological progress happens and the labor market changes over time. And what we want is a level of inflation that is low enough such that it is not a conscious part of decision-making by the American people and American businesses. And 2% is a level of inflation that allows the economy to make the adjustments to wages and prices in a way that is not thought to be significant enough to be a part of the daily thinking of economic decision makers. And your question really gets at the meaning of the word stability, what price stability means. And one can have a discussion of whether or not a larger number than 2% strikes oneself or maybe the American people as an appropriate level to be consistent with the use of the word stability. Once you think about larger numbers, then different people can start to think differently about, really, is that what I would think of as a stable price adjustment? So let me stop right there with that.
I just want, Vice Chair Jefferson, on behalf of Davidson College and President Hicks, want to thank you for spending time with our faculty and our students today, with all of us this evening. I want to thank you for your support and friendship as a colleague when you were here, and for doing what so many of our students do, stepping up and serving the public good. Thank you.
Thank you. It's a pleasure to be here.